Welcome. Today, we're diving into the world of mortgage escrow. If you've ever wondered what happens to your property taxes and homeowners insurance when you pay your mortgage, you're in the right place. Mortgage escrow is a term that often confuses new homeowners, but understanding it is crucial for managing your finances and protecting your investment. In this video, we'll break down what mortgage escrow is, why it exists, and how it works in the context of homeownership. Let's start by looking at the basics of escrow accounts and their role in your mortgage journey. So, what exactly is escrow? In the context of mortgages, escrow refers to a special account set up by your lender. This account is used to collect and hold funds for certain property-related expenses, like property taxes and homeowners insurance. Instead of paying these large bills directly, you pay a portion of them each month along with your mortgage payment. The lender then uses the escrow account to pay these bills on your behalf when they're due. This system helps ensure that these critical expenses are always paid on time, protecting both you and the lender from potential issues. You might be wondering why lenders require escrow accounts in the first place. The main reason is to protect their investment. If property taxes or insurance premiums go unpaid, the lender's collateral, the home, could be at risk. For example, unpaid taxes could lead to a tax lien, and lack of insurance could leave the property vulnerable to damage. By managing these payments through escrow, lenders ensure that these essential bills are always paid on time, reducing risk for everyone involved. This system also helps homeowners by spreading out large annual expenses into manageable monthly payments. Let's walk through how escrow works in practice. Each month, when you make your mortgage payment, a portion of that payment goes into your escrow account. The lender keeps track of how much is needed for your property taxes and insurance premiums. When those bills come due, the lender pays them directly from the escrow account. This means you don't have to worry about saving up for large, lump sum payments. Instead, you're budgeting for these expenses throughout the year, making homeownership more predictable and less stressful. Escrow accounts typically cover two main expenses: property taxes and homeowners insurance. In some cases, they may also include other costs, such as flood insurance or mortgage insurance, depending on your loan agreement and location. The lender estimates the total annual cost of these expenses and divides that amount by 12 to determine your monthly escrow payment. This way, you're always contributing enough to cover the bills when they're due, and you avoid any surprises. When you close on your home, your lender will usually set up the escrow account as part of the mortgage process. At closing, you may be required to deposit a certain amount into the escrow account to ensure there's enough to cover upcoming bills. After that, your monthly mortgage payments will include the escrow portion. The lender will provide you with statements showing how much is in the account and what payments have been made, so you can keep track of everything easily. Each year, your lender will perform an escrow analysis. This process reviews the actual costs of your property taxes and insurance compared to what was estimated. If the bills were higher or lower than expected, your monthly escrow payment may be adjusted for the next year. This helps ensure that your escrow account always has enough funds to cover your expenses, and you're not caught off guard by changes in tax rates or insurance premiums. Sometimes, your escrow account may not have enough funds to cover your bills. This is called an escrow shortage. It can happen if your property taxes or insurance premiums increase unexpectedly. If there's a shortage, your lender will typically give you the option to pay the difference in a lump sum or spread it out over the next year's payments. Either way, your monthly escrow payment will likely increase to prevent future shortages. On the flip side, if your escrow account ends up with more money than needed, this is called an escrow surplus. This can happen if your taxes or insurance premiums decrease, or if the lender overestimated the costs. In most cases, if the surplus is over a certain amount, your lender will send you a refund. Alternatively, they may apply the surplus to your future escrow payments, lowering your monthly bill. Your total monthly mortgage payment is made up of several parts: principal, interest, taxes, and insurance. The taxes and insurance portion is what goes into your escrow account. This is often referred to as PITI: principal, interest, taxes, and insurance. Understanding this breakdown helps you see exactly where your money is going each month and why escrow is such an important part of the process. Lenders are required to provide you with regular escrow account statements. These statements detail how much money has been collected, what payments have been made, and the current balance in your account. Reviewing these statements helps you stay informed and spot any discrepancies early. It's a good habit to check your escrow statements at least once a year, especially after your lender performs the annual escrow analysis. Typically, your mortgage lender or loan servicer manages the escrow account. They are responsible for collecting your monthly payments, keeping track of the account balance, and making sure all bills are paid on time. If you ever refinance your mortgage or sell your home, the escrow account will be closed and any remaining funds will be returned to you. Not all mortgages require an escrow account, but many lenders do, especially for loans with lower down payments or government-backed loans. Some lenders may allow you to waive escrow if you meet certain criteria, like having a large down payment or a strong credit history. However, waiving escrow means you'll be responsible for paying taxes and insurance directly, which can be a big responsibility. If you're considering waiving escrow, it's important to weigh the pros and cons. On the plus side, you have more control over your money and can potentially earn interest on funds you would otherwise keep in escrow. However, you'll need to be disciplined about saving for large bills and making payments on time. Missing a tax or insurance payment can have serious consequences, including penalties or even foreclosure. When you refinance your mortgage, your existing escrow account is usually closed, any remaining funds are refunded to you, and a new escrow account is set up with your new loan. It's important to keep track of these transitions to ensure there are no gaps in your property tax or insurance coverage during the refinancing process. If you sell your home, your escrow account will be closed as part of the sale process. Any remaining balance in the account will be returned to you after all outstanding bills are paid. This ensures that you're not leaving any unpaid taxes or insurance behind when you transfer ownership of the property. For new construction homes, escrow accounts work similarly, but there may be some differences. Property taxes and insurance estimates can be tricky since the home is newly built. Lenders may use estimated values for the first year and adjust your escrow payments once actual bills arrive. It's important to review your escrow statements closely during the first year in a new home. Property taxes are a major component of your escrow account. These taxes are assessed by your local government and can change from year to year. Your lender will estimate the amount due based on previous tax bills and adjust your escrow payments as needed. Staying aware of local tax changes can help you anticipate adjustments to your escrow account. Homeowners insurance is another key expense covered by escrow. This insurance protects your home against damage from fire, storms, theft, and other risks. Your lender will require proof of insurance and will pay the premium from your escrow account each year. If your insurance premium changes, your escrow payment will be adjusted accordingly. If you live in a flood-prone area, your lender may require you to carry flood insurance. The premium for this insurance can also be included in your escrow account. This ensures that your property is fully protected and that the lender's investment is secure, even in the event of a natural disaster. Some loans, especially those with low down payments, require mortgage insurance. This insurance protects the lender in case you default on the loan. The premium for mortgage insurance can also be included in your escrow account, making it easier to manage all your housing-related expenses in one place. Lenders often require a small extra amount, called a cushion, to be kept in your escrow account. This cushion helps cover unexpected increases in taxes or insurance premiums. The amount of the cushion is regulated by law and is usually equal to 2 months' worth of escrow payments. This extra buffer helps prevent shortages and ensures your bills are always paid on time. In some states, lenders are required to pay interest on the funds held in your escrow account. This means you could earn a small amount of interest on the money set aside for taxes and insurance. However, the interest rates are typically very low, so it's not a significant source of income. Be sure to check your state's laws to see if this applies to you. Mistakes can happen with escrow accounts, such as incorrect tax or insurance payments, or miscalculations in your monthly payment. If you notice an error on your escrow statement, contact your lender right away to resolve the issue. Keeping good records and reviewing your statements regularly can help you catch errors early and avoid bigger problems down the line. One of the biggest benefits of escrow is that it helps with budgeting. By spreading out large annual expenses into smaller monthly payments, you can better manage your cash flow and avoid financial surprises. This makes it easier to plan for other expenses and maintain a healthy household budget. Knowing that your property taxes and insurance are being paid on time can give you peace of mind as a homeowner. You don't have to worry about missing deadlines or facing penalties. The escrow system is designed to make homeownership less stressful and more predictable, so you can focus on enjoying your home. Escrow accounts are a standard part of the homeownership experience for many people. They help ensure that important bills are paid, protect your investment, and simplify the financial side of owning a home. Understanding how escrow works can help you make better decisions and avoid common pitfalls as a homeowner. From the lender's perspective, escrow accounts are a way to protect their investment in your property. By ensuring that taxes and insurance are always paid, lenders reduce the risk of losing their collateral or facing unexpected costs. This is why many lenders require escrow accounts, especially for borrowers with smaller down payments. Escrow accounts also protect homebuyers by making sure that critical bills are paid on time. This helps you avoid late fees, penalties, and the risk of losing your home due to unpaid taxes or insurance. The escrow system is designed to make homeownership safer and more manageable for everyone involved. The requirement for escrow accounts can vary depending on the type of loan you have. Government-backed loans like FHA and VA loans almost always require escrow, while conventional loans may offer more flexibility. It's important to understand your loan's requirements so you know what to expect when it comes to escrow. Your down payment amount can affect whether you're required to have an escrow account. Borrowers with smaller down payments are seen as higher risk, so lenders are more likely to require escrow. If you make a large down payment, you may have the option to waive escrow, but you'll need to handle taxes and insurance yourself. Sometimes, your mortgage may be sold to a new loan servicer. If this happens, your escrow account will be transferred to the new servicer, and they will take over managing your payments. You'll receive notification of the change, and your monthly payment process should remain the same. If your property taxes or insurance premiums go up, your monthly escrow payment will increase as well. Your lender will notify you of the change and provide an updated payment schedule. It's important to budget for these potential increases to avoid surprises. If your property taxes or insurance premiums decrease, your monthly escrow payment may go down as well. Your lender will adjust your payment and let you know about the change. This can provide some relief in your monthly budget and is one of the benefits of regular escrow analysis. Missing a mortgage payment can have serious consequences, including a shortage in your escrow account. If your escrow account doesn't have enough funds to pay your taxes or insurance, you could face late fees, penalties, or even risk losing your home. Always make your mortgage payments on time to keep your escrow account in good standing. Good communication with your lender or loan servicer is key to managing your escrow account. If you have questions about your escrow payments, statements, or account balance, don't hesitate to reach out. Staying informed and proactive can help you avoid misunderstandings and keep your account running smoothly. Many lenders now offer online access to your escrow account information. You can log into your account to view statements, track payments, and see your current balance. This makes it easier than ever to stay on top of your escrow account and manage your finances from anywhere. If you ever have issues with your escrow account, customer service representatives are there to help. Whether you need to dispute a charge, request a statement, or ask about your account balance, don't hesitate to contact your lender's customer service team. They can guide you through the process and help resolve any problems. Here are a few tips for managing your escrow account. Review your statements regularly, keep good records, and budget for potential increases in taxes or insurance. If you notice any discrepancies, contact your lender right away. Staying organized and proactive will help you avoid surprises and keep your finances on track. Including your escrow payments in your overall financial plan is a smart move. By accounting for these regular expenses, you can create a more accurate budget and avoid financial stress. Remember, escrow is there to help you manage big bills and protect your investment, so make it a regular part of your financial planning. While the money you pay into escrow isn't tax deductible, the property taxes and mortgage interest paid from your escrow account may be. Be sure to keep records of these payments and consult a tax professional to see what deductions you may qualify for. This can help you maximize your tax benefits as a homeowner. Make it a habit to review your escrow account annually, especially after your lender completes the escrow analysis. This is the best time to check for errors, ask questions, and make sure your account is on track. Staying engaged with your escrow account helps you avoid surprises and keeps your finances healthy. As you move forward in your homeownership journey, understanding escrow will help you make better decisions and avoid common pitfalls. Whether you're buying your first home or refinancing, knowing how escrow works gives you confidence and control over your finances. Remember, your lender is there to help, so don't hesitate to ask questions along the way. Let's recap what we've learned about mortgage escrow. Escrow accounts help manage your property taxes and insurance, protect both you and your lender, and make budgeting easier. By understanding how escrow works, you can take control of your finances and enjoy a smoother homeownership experience. Remember to review your statements, communicate with your lender, and stay proactive about your account. Thanks for joining us to learn about mortgage escrow. With this knowledge, you're better equipped to navigate the world of homeownership and make informed financial decisions. Remember, escrow is there to help you manage important bills and protect your investment. Stay informed, stay organized, and enjoy your home with confidence.